Ever since the explosive Chewy IPO last week, I can't stop thinking about that humanization of pets theory we had. That's the idea that Americans increasingly treat their cats and dogs as members of the family. And when you act like your pets are human, as we do at home, you spend a lot more money on food and healthcare. Now, I've been pounding the table on this story for ages. You know that. That's why last August, we actually created an ETF, a whole humanization of pets ETF, an index consisting of our 10 favorite names in the space. In the wake of the Chewy deal, I think it's worth checking up on this ETF and maybe even updating it because there have been some changes. As it turns out, we were a little early with this one. The Mad Money Humanization of Pets ETF is up nearly 5% since we created it less than 10 months ago, only slightly better than the 2.6% return from the S&P 500 over that exact same period. Impressive, maybe unimpressive. However, like I said, we were early. If you look at the performance over the course of 2019, it tells a very different story. The Pets ETF is up roughly 25% year-to-date, trouncing the 16% return for the S&P 500. In the original formulation, we had different weightings for each of the 10 stocks in the index. Central Garden and Pet Company, Pet IQ, Pet Med Express, they got 10%. IDEX Laboratories, Zoetis, and Freshpet got 15%. And then some of the less focused ones like General Mills, Henry Schein, J.M. Smucker, and Walmart, remember they sell pet food, none of them pure plays, got anywhere from 4.5 to 8%. Now, some of these were big, big winners. But we also had 3 double-digit losers. Central Garden and Pet. It's down almost 27%. Pet IQ fell nearly 21%. Pet Med Express lost more than half of its value. Thanks for nothing. Still mad about that. Those are some real stinkers, frankly, that have been a huge drag on the pet ETF's overall performance. Even IDEX, the Cramer veterinary diagnostic equipment maker, was up as a laggard. It's up just 9%. Everything else rallied double digits. Of course, the timing on this thing was awful. We created the Humanization of Pets ETF last August, right before the stock market peaked and then melted down in the fourth quarter. That sell-off was particularly hard on high-flying growth stocks like IDEX. And while these names have come back into the style of the Wall Street fashion show, well, you know what? They had to climb out of a very big hole. On the other hand, Freshpet and Zoetis, the two other top holdings in our fictional ETF, were up 35 and 24% respectively. And it's a good thing we included some big packaged food companies like General Mills, okay, Blue Buffalo, that's what they own, Smucker for their pet food divisions, as both stocks have rallied just under 20% over the same period. Walmart's up 16%. That's a real favor stock. Amazing. I think it just creeps up and creeps up. Now, and since the beginning of 2019, these stocks have really caught fire. Only Central Garden and Pet Med are down year to date. Everything else is up by 15% or more. Those are some spectacular numbers. So Zoetis, the gigantic veterinary healthcare company we have on all the time, it's rallied 30% for the year. It's still only the 6th best performer. In short, the humanization of pets theme is red hot right now, but you need to be selective about how you play it. So what happened with those losers in our pet ETF, and what should we do about them? Do we dump them from the index entirely or just cut our exposure? This is not easy to do. Look, the big problems here, Central Garden, Pet IQ, and Pet Med Express. We got to dissect these. 3 stocks bouncing of late, but their overall performance is still pretty hideous.
The House of
So let's take them one by one. Central Garden and Pet distributes pet, lawn, and garden supplies, although most of its business is pet-related. The stock got obliterated when the company reported a hideous quarter in February. CEO George Roth tried to reassure his investors, but then 5 days later, he announced his upcoming planned retirement. It didn't help that Central Garden and Pet gets 40% of its sales from the garden side of the business, and gardening got a very late start this year because of the awful weather. Tell me about it as a gardener. The good news is Central Garden has already bottomed after the company delivered better than expected results in May. At these levels, the stock has gotten a lot cheaper than it was last year, and you know what? It would be a mistake to totally bail on it. So let's keep Central Garden and Pet in the ETF, but cut its weighting from 10% to 5%. Next up, there's Pet IQ. It's a maker of drugs for animals, as well as an operator of veterinary clinics. We just had a very bullish conversation with the CEO right before we created the Humanization of Pets Index. However, his stock had also run from the mid-20s to just under 40 in a very short period of time. And in retrospect, I was chasing when I recommended it at that level. That was wrong. Sure enough, Pet IQ was crushed during the growth sell-off in the fourth quarter, and it's never really come back. Plus, it doesn't help that the company reported a not-so-hot quarter in March, and then some short sellers started going after them for their VIP pet care acquisition, which gave them the veterinary clinic business. We like that business. However, last month, Pet IQ reported a solid quarter. And we learned that they're acquiring Parago's animal health unit for $185 million in a deal expected to be additive to earnings within a year of its closing. While I don't have a great read on that VIP pet care situation, the story seems intact to me. I still think that has enormous potential, but we want to cut PetIQ's allocation from 10% to 5%. Leave it in the portfolio. Now, third, there's Pet Med Express, the company behind 1-800-PET-MEDS, America's largest animal-oriented pharmacy. This stock had already been pulverized when we created the ETF. They recently reported a shortfall, and I should have followed my own rules by keeping it in the penalty box. Remember what I always say? A shortfall means you got to at least wait 1 quarter. I didn't listen to myself. PetMed's struggling with new competitors in the space, including Chewy, and an online pet pharmacy launched by Walmart. While the stock seems cheap, I have a hard time believing PetMed will be able to make the numbers. So we're removing it from the Humanization of Pets ETF entirely. Sorry, gone. We also need to remove Henry Schein. Why? Because the company spun off its animal health unit back in February. They merged it with Vets First Choice to create a new entry, Covetrus. Covetrus. Wasn't that like that could have been that bank, that BBT and SunTrust? Covetrus. Or it could have been the plant division of DuPont Dow, or you know what I mean? Now, this company is a major distributor of veterinary supplies, but its stock has been a dud so far, in part because Covetrus laid an egg in its first earnings report as an independent company. Plus, it's not cheap, selling for 25 times next year's earnings estimates. The company is an important player in the pet space, but it still needs to prove itself. So let's put it in the ETF, but only with a 6.25% weighting. Speaking of breakups, late last year, Eli Lilly spun off its animal health division as Elanco. Unfortunately, the stock's basically been dead money since its first trade. It surged from 24 to 32 right out of the gate, and that's where it stayed. Problem? Lilly spun out of Elanco via an IPO, which led investors to bid up the stock, and it's been digesting those gains ever since. Still, I like the company. Straightforward story. You know what we're going to do? We're going to give a 7.5% weighting. Finally, there's Chewy. Yes, Chewy. I like Chewy. The online pet store that we joined this weekend, that's right. It's upending the whole industry, which exploded higher when it came public on Friday. Like I told you at the time, I adore Chewy, the company. But ideally, yes, I would like to wait for the stock to cool off a bit before I endorsed it. That said, it's a lot less expensive than it might seem. I say we give it a 12.5% allocation, although, again, if you want to buy it, you should gradually buy it on the way down. But I do sanction buying it a little bit right here. Bottom line, the humanization of pets has been a fabulous secular growth story, one that's really paid off in 2019. And now that we've adjusted our Mad Money Pets ETF, I bet it can keep going higher. Hey, let's speak to Sarah in Iowa. Sarah.
Hi, Jim.
Hi, Sarah.
Thank you for teaching us how to do the homework.
Mm-hmm.
My question is on Moderna recent IPO. I bought on belief. We all know what they're doing currently. So I bought it at 22. My question is, should I buy it now on this dip and get my cost down, or is that being a hog?
I would buy some. When I saw I think that the company Array is a really good company that Pfizer bought, but I think that these are all, in the end, good specs. I like that. I met management. I would endorse it. The stock fell during a period when people didn't like these stocks. They're starting to warm up to them again. I would go for it. How about Shane in Pennsylvania? Shane!
Hey, Jim. How's it going? I hope you had a great Father's Day.
Oh, I tell you, I had a terrific one. My kids all weighed in. That's all I care about. How about you?
Yeah, I had a good one. Thanks.
Good.
So my stock is Allergan. I've owned the stock for about 2 years. Been getting crushed, but I'm only 25. I think I still got some time to go. Do you think I should buy, sell, or hold?
I think that it can be. I mean, you hit it the 52-week low. It'd be a big mistake for me to just tell you to sell it here. It doesn't have the growth that I'd like. It doesn't have the pipeline that I thought it did. We managed to sell it for the charitable trust at a higher level, but it still hurt us. I'm not a fan. Let's just put it that way. Eric in Massachusetts. Eric.
Hey, Dr. Cramer, big booyah.
Oh, thank you.
First-time caller. My question is about Wayfair, ticker symbol W.
Right.
First quarter's estimates, but showed a 39% increase year over year on revenue.
Yeah, but doesn't make any money. I'm going to tell you, I'm going to guide you toward RH, the old Restoration Hardware. We just had Gary Friedman on. I could have been more bullish, bought back 60% of the company. 6-0 in the last 3 years. That's who I want to bank with. All right, the humanization pets is a fabulous long-term growth story. And you know I like this Chewy. I bet the new Mad Money Pets ETF can keep going higher. Watch more Mad Money ahead, including my exclusive with a company that has matched over 3 million students. The company's looking to hire top talent across the country. Do not miss my exclusive with just a very uplifting story. Private player handshake. Yes, glass pants. Oh, I'm sorry, glass hands. Then some pundits are saying it's the most difficult Fed meeting to game in ages. I'm calling it an easy call. I'll explain. And all your calls, rapid fire. Tonight's edition of the lightning round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.